If you're watching this right now, it's because you have some level of interest in real estate, investing in real estate, developing real estate, and you want to understand the climate of the market, how to take advantage of the best acquisitions out there, and how to position yourself correctly to win in the real estate game. So today, we're going to talk about just that, the current state of the market, where the problems lie, and where opportunities sit, and how to take advantage of them. The commercial real estate market is on the brinks of collapsing, and there's going to be a ripple effect that comes down the line and affect small investors, single-family home investors. And the big question is, where is this coming from, and how can it be prevented, fixed, changed, mitigated, or just taken advantage of on a resource that you can go in and generate capital from? And so I've been asked, Jerome, we understand that there's an effect when there's high interest rates and the commercial market sector gets blasted because of how expensive money is. But is that the only variable? Is that the only variable that's affecting commercial real estate? And the answer is no. In fact, on the forefront, the answer is yes. But that sector can be fixed with just a few modest rate reductions. Now, there will be people that get affected by it. There'll be financial institutions that will get affected by it. There will be REITs, syndicators, syndication firms, investors that will be affected by it. Because any time that there's a variable where there's market distress in any sector, they're affected by it. But what is the big sector and that's really affecting the commercial market sector right now? And what's the solution? And that's what we're going to go over today. One of the big things, ladies and gentlemen, is that I always like, if you're watching this right now, it's because you have some level of interest in real estate, investing in real estate, developing real estate, and you want to understand the climate of the market, how to take advantage of the best acquisitions out there, and how to position yourself correctly to win in the real estate game. So today, we're going to talk about just that, the current state of the market, where the problems lie, and where opportunity sits, and how to take advantage of them. And so one of the big things is the biggest sector right now that's being affected that nobody on this earth knew and could foresee was that office was going to go vacant during the pandemic. And when office went vacant, nobody foresaw that 40% of small businesses would never return to the office. And so when we compare this to two working variables that are affecting the commercial market sector right now, there's some similarities, but there's some very large differences. So let's go over these. And so when interest rates get high, okay, not just affecting office, affecting every sector of commercial real estate that's out there, and even single family real estate, because when mortgage rates are high, when interest rates are high, money's being lent at a more expensive value, homeowners contract and they're not buying as much real estate. Hence, it slows down the market, which is what actually drives down inflation, because housing is the number one purchase for most American people. And so it starts from the bottom. Now, when we look at it from a commercial standpoint, what most people don't realize, even investors that think they're sophisticated investors, don't really realize what the banks are looking for in relation to revenue, values, and money, and how it sits and relates to how the market is actually getting hit right now. And so here's how it works, ladies and gentlemen. So let's take an office building, let's not compare it to an office building, because we're going to talk about office here just shortly. Let's compare this to a retail center. Let's compare this to multifamily, which is one of the hot markets to invest in. Let's talk about warehouse. So one of the big things is that when money becomes expensive, even in desirable assets like storage, multifamily, warehouses, what ends up happening is that when cap rates start to rise and the cap rates go up, now a cap rate is the actual return on your investment. So if you go in and a warehouse says it costs you $1 million and the cap rate is 10%, well, the return on your investment annually is that 10%. So it's like investing in the stocks. When you go and you invest in the stock market and you get a 6% return on your stock, it's a 6% return on what your initial investment was on that stock annually. And so that's a cap rate. Now, when cap rates actually start to rise, because we had 3% interest rates, and what most people don't realize is that cap rates and interest rates have to run in parallel to each other. Because if you have an investment that you're making 3% on, and that's what you purchased it for, is a 3% return investment, and your interest rate is 3%, you're able to afford to pay the debt. So that asset at one point in time, just 2 years ago, could sell for 3% interest rate and a 3% cap rate and function just fine because you're still making your spread on your equity. And so you still have profitability. Now, when interest rates rise, if you have to refinance, okay, because pay attention to this. If you have to refinance, or if you're purchasing an asset or just trying to sell an asset off because maybe you have a fluctuating rate mortgage, or maybe you have a 5-1 arm where it was fixed and now it's going to fluctuate at its fifth year. Because if you think of 2019, 20, 21, 22, 23, that's 5 years. Now we're in 2024, ladies and gentlemen, year number 6. So a lot of investors and syndicators, the way they work is that they buy an asset for this price and they do what's called value add. They add value to this price and they make a spread of increased rents and revenue in here to this price, and then they sell it. Well, if you go in from a 3% interest rate to a 6% interest rate, now you have to sell that at a 6% cap rate. And so when cap rates go up, values of the assets, they go down, okay? And when cap rates go down, values go way high. So what happened in 2021, 22 is that cap rates went way down, so values went through the roof. And now interest rates are rising, so interest rates are rising, and with interest rates rising, cap rates have to rise, and values are getting crushed. So if you take a building that was once worth $30 million just a few years ago, and now it's only worth $20 million based on just a cap rate alone, how do you sell a $30 million? How do you go out and refinance or sell a $30 million asset for $20 million? And the answer is you can't. And that's where an asset becomes a liability in multifamily, in storage, and in warehouse. And so understanding this is a crucial element for investors. But it's also the place that holds a ton of value in regards to opportunity for those people that are coming in, buying foreclosed or short of what's owed on the property, okay? So when you go in and you buy an asset and you buy it short, that means you bought it short of its original mortgage standpoint. And so you're going in, you're buying them, if the mortgage was on that same $30 million building with 20% equity in that building, right? That's $6 million. So if you bought it for so if they had $24 million mortgage on an 80% loan to cost, they had an $80 million mortgage, a $24 million mortgage on that building still. So they have a $24 million mortgage on that building, and they go in and they have to pay $20 million because that's all it's worth today. They get a $4 million savings. Now, here's one thing that's cool is that historically, real estate has always went up. So if you look back to the 1900s, back before the Great Depression, before all the big financial busts that the U.S. American people have embarked and faced over the years, one thing has happened. The stock market and real estate has always continued to go up and climb over the course of time. So for those people that are able to get into a $30 million asset for $20 million asset, for $20 million, for sake of example, at some point in time in the near future, will have massive wins. So even like our multifamily that we're building right now, people go, well, Jerome, how does this affect new construction? Well, it does, because I might have underwrote that same asset. It might have taken me $24 million to build, and I had a $6 million spread of equity, and it was worth $30 million. But now because of cap rates, now that same asset's only worth $24 million. But here's the difference. I can now just build that asset, and I build it for free. And so I walk in and I just build the assets for free. And I know this, and I've worked for free a lot of times in my life. As I see market volatility, the market goes up, then it comes down, then it goes up, then it comes down. But here's what happens, ladies and gentlemen. When the market comes down and you build for free down here, now I can ride the wave all the way up. And as I do that and I cash out on that thing up here, even if I don't sell it, I just refinance, and when interest rates lower and values go back up, I crush it and make millions of dollars over the course of time, and you can too. And that, ladies and gentlemen, is where the opportunity comes from in the first sector of real estate that's getting blasted right now because of interest rates. And truth be told, that's the smaller sector of the economy that's getting blasted from commercial real estate right now. Now let's talk about number two, because number two is extremely interesting. You're going to want to understand why this is so detrimental to the commercial market sector place. And so when you guys look at this, the number two sector that's really distressing commercial real estate right now is office. Because office, every major bank, every large institutional bank, every regional bank has office in their portfolio. So much so that it accounts for almost 80% of their overall commercial portfolio for a lot of regional and national banks. And so when COVID hit in 2019 and office space went delinquent, tenants started going delinquent on their rents because they didn't have employees in the office. Companies were getting distressed. Landlords weren't getting payments on their buildings. And so they were already starting to fall behind on their payments. Now, they were expecting that at some point in time, these people would go back to the office and things would resume as normal. And if they could weather this short-term spread, they could maybe get a bridge loan to be able to offset the interest payments or restructure these loans or get government bailouts. So even through government bailouts, small business bailouts, all of the payroll protection bailouts, in spite of all of that stuff that the government did, it still didn't fix one major thing. 40% of small business owners will never return to the office. And so if you take sub-rural communities, you take less tertiary areas that don't have the economic growth that the large cities have, and even states and cities like Boston, Massachusetts, 40% of these massive skyscrapers, people are not going to the office and they're still empty right now today. And so that means that banks are going to have a 40% reduction in their portfolios of assets that they once lent on years back. They'll never replace their income. So if you shave any company's bottom line by 40%, what happens? The vast majority of companies, like 95% of them, will go out of business. And so the big worry right now is not just for the investors, but the institutions and predominantly the regional banks. Because you take these regional banks, which are the strength of our communities that we walk by every single day. These are not the Bank of Americas. These are not the Chase. These are not the JP Morgans and the Merrill Lynches and the Goldman Sachs. Ladies and gentlemen, these are your regional banks that are in your local areas that are regional between we're in the Southwest, so Colorado, maybe Oklahoma, Texas, and New Mexico. Or a bank that's just between Colorado and New Mexico. Or a bank that's just between Indianapolis and Illinois, or between Kansas City and in Missouri, And so you might have just a regional bank that's within 1, 2, 3 states. And those are the banks, ladies and gentlemen, that are getting blasted hard because 40% of the revenue will never, ever be replaced. And so how do you take all these banks that lose 40% of their revenue, and how do you offset this? Now, people say, oh, we just reposition the real estate in office into multifamily and housing, or we take it and we do storage with it, and we'll just do climate-controlled storage and gut these buildings out. And the problem is there's only so much multifamily that can be converted, and there's only so much climate-controlled storage that can be utilized within any city. And that's not even the biggest problem. That stuff can be repositioned, but here's the big but. It's easier said than done because there is a process of zoning, city restrictions, and reappropriating of zoning and entitlement that has to take place that most people and most developers, they can't weather the time that it takes in most municipalities to get it done quick enough to offset the bank's losses in a time frame that makes sense. Because there's cities that you go in and you reposition this stuff that you're going to get pushback from. They don't want to see multifamily where there was office corridors. They don't want to see warehouse in the middle of a downtown area where there was office corridors. So they're sitting back going, okay, we had this master plan of office, and now they're giving pushback because they don't understand and appreciate the financial sectors and what's going through this. And so you're getting municipal and local setback from these areas that you cannot push quick enough to make them rezone these assets. Because yes, it's on the forefront, but it's not in their face and they're not breathing it financially. And so you land up with political pushback because of zoning and entitlement issues. And so even if you get through those barriers and it takes you 1 year, 2 years to be able to go in and rezone and re-entitle these assets, now you have another 2 years of development. So you're like 4 years to be able to turn these assets. Now, we're doing it on a small scale. And for those of you guys that are looking at this, yes, some of these assets are going to bring massive opportunity in the market. So pay attention to them. Because as investors, contractors, developers, these are going to make you tons of money. If you guys haven't heard about my Youngtown project, it was a massive success where we took a $1.8 million office building and we converted it into multifamily, making it worth over $31 million with about a $15 million all out-of-pocket investment. And so we were able to take a 30% leased, 70% vacant office building, and we turned it into a big, giant W, right? It was a big win. But with that said, that's one small building out of millions of square feet across the United States that are being affected right now. And so we want to watch this unfold. And as it unfolds, I'm going to bring you more information, more data to be able to make sure that you guys have the latest, greatest, and best information to make logical investment decisions. But in the time being, pay attention in your market sector for opportunity in office and to buy property short due to the reduction in values due to the increased interest rates and increased cap rates and the offset that people cannot withhold of their payments over the course of several months into years, and the opportunity exists in financially distressed real estate, ladies and gentlemen. If you guys like content just like this, then crush and smash that thumbs up button and smash and subscribe our YouTube channel and give us some feedback. Whether you love it, like it, hate it, do something. Just give us some feedback to make your next experience in working with us and learning about your real estate investment experience, make it a successful one. Comment below, and I look forward to seeing you next time.